Dividend investing is one of the most time-tested ways to build long-term wealth. But if your strategy starts and ends with chasing high yields, you're setting yourself up for disappointment. Because the truth is, yield is just the starting line. What really matters is whether a company can sustain that dividend and, ideally, grow it over time. Let's break down how to measure dividend quality the right way. Start with the payout ratio. This is one of the most basic metrics, but it still matters. It tells you what percentage of a company's earnings are going out the door as dividends. If a company earns $4 per share and pays $2 in dividends, its payout ratio is 50%. That's generally a healthy level. It shows the business is rewarding shareholders while retaining half its profits for reinvestment or balance sheet strength. Now, anything above 70% starts to raise yellow flags. If you're looking at a company with a 90% or higher payout ratio, that's a warning. At that point, the dividend depends on near-perfect execution just to be maintained. One earnings miss, and the dividend becomes vulnerable. But here's where things get interesting. Earnings per share can be a misleading number. It's affected by non-cash charges, accounting decisions, and at times, outright manipulation. A company can show healthy earnings, but be burning through cash behind the scenes. That's why I don't stop with EPS. I prefer to focus on the stock's free cash flow payout ratio. This is the gold standard for dividend sustainability. Free cash flow is the money left over after the company pays for its operating expenses and capital expenditures. It's the cash in hand available to pay dividends, buy back shares, reduce debt, or reinvest. If there's no free cash flow, the dividend might be funded with debt or asset sales, which is obviously not sustainable. Let's take a real-world example. Target, ticker symbol TGT, pays a 4.76% dividend and distributes $4.48 per share annually. That sounds solid, but here's the key. Target also generated $4.47 billion in free cash flow last quarter. That gives it a free cash flow yield over 10%, so the dividend is not only well covered, it's covered with real durable cash. That's what dividend quality looks like. On the flip side, if a company is paying out more than it generates in free cash, you've got a problem. It may not be obvious right away, but eventually the cracks will show. Whether Wall Street sees it yet or not, that dividend is walking on a tightrope. Now let's move to dividend growth, which is one of the most overlooked quality signals. A high yield might look attractive, but a growing dividend tells you a lot more. It's a clear signal from management that they believe the business can keep generating strong, sustainable cash flow. ConocoPhillips is a perfect case study. It's a business operating in the highly cyclical energy sector, but they've raised their dividend annually since 2016. Through oil collapses and macro turmoil, they stayed committed to their payout. That's not just good policy, it's part of the company's DNA. Of course, not all companies can sustain that kind of record. If you see a dividend cut after just a few quarters of earnings pressure, that's a red flag. Sometimes cuts are necessary resets, but they break investor trust and take years to recover from. Next up, the balance sheet. This is where a lot of income-focused investors fall short. Even if earnings and free cash flow look good, a shaky balance sheet can derail the dividend. Delta Airlines is a good example of a company rebuilding its balance sheet post-crisis. Since reinstating its dividend in 2023, Delta has paid down over $5.3 billion in long-term debt. That's real progress, not just financial optics. It shows management is prioritizing long-term sustainability over short-term appeasement. But not all dividends are created equal across sectors. Some industries are naturally more generous with payouts. A 70% payout ratio might be perfectly normal for a utility, but would be excessive for a tech company or industrial. This is why sector context matters. Then there's business model resilience. This might be the most important factor of all. because the foundation of any good dividend is a business that can keep generating cash in both good times and bad. Target checks those boxes with its private label dominance. Levi Strauss has a global brand and direct-to-consumer growth. And Delta's loyalty program turns flyers into repeat revenue. Levi's faced tariff shocks, rising costs, and a rough fashion cycle, but still raised its dividend. That kind of discipline doesn't make headlines, but it builds shareholder trust. Now let's talk about dividend traps. The too good to be true situations. If a stock has a yield above 7%, no cash flow support, a rising payout ratio, and deteriorating earnings, you're probably looking at a trap, especially if there's no credible turnaround plan in sight. One way to sanity check is this. Compare the dividend yield to the free cash flow yield. If the dividend yield is higher, that's a problem. It means the dividend might not be backed by real money. Proceed with caution. Finally, don't forget valuation. A great dividend at the wrong price is still a bad investment. Use tools like price to earnings, price to free cash flow, and price to book. If a company yields 4%, but trades at 30 times cash flow and shows no growth, you're buying a bond wrapped in risk. But if you find a business like Target, offering a nearly 5% yield, trading at a 10% free cash flow yield with improving results, that's an equity bond worth owning. That's how you stack the odds in your favor. In the end, great dividend investing isn't about reaching. It's about knowing what to hold. Prioritize cash generation, respect the balance sheet, look for steady hands at the helm, and be patient enough to let those quiet cash flows do their job. Because the best dividends aren't the loudest. They're the most reliable. If this helped refine your dividend game, hit like and subscribe. There's more coming on cash flow investing and smart portfolio strategy. For full reports and trade alerts, head to my Substack. The link's in the description.